It's closing in on being a year ago that I released a Patreon together with a friend of mine, where you guys can see pretty much everything that's going on in my private stock market portfolio and why. In this video, I'll reveal 6 of the companies that we've invested in that we think make sense to buy and hold for the next 6 months, together with some important updates to the Patreon itself. First of all, how has the portfolio performed? Since I began investing in August 2013, that's about 11 years ago now, I've beaten both the S&P 500 and the DJ World indices by quite a wide margin. Here, you can see that the difference is some 200% and 300% respectively, according to my broker, but when I make my own calculations based on IRR, it's even larger than that. Depending on if you take my word for it or not, the performance ranges from my broker's estimated CAGR of 16% to my own estimate of 19%. Meanwhile, the S&P 500 has performed 11% and the DJ World has performed 6.5%. My performance is after fees and taxes, by the way. Now, what about last year while we've had the Patreon? Well, even though small and micro caps, which is where we invest, have underperformed during the last year, even though value investing typically performs better in bear markets rather than bull markets, and even though we were completely scammed by insider information in one of our largest holdings, Kindred, we've managed to outperform. I'm up some 17.4% or 18.5% depending on if you trust me or my broker with these calculations. The S&P 500 is up 15.2% and the DJ World is up 11.7%. We're quite pleased with this performance from an absolute standpoint, but unfortunately not from an efficiency standpoint. We've been getting a similar return to what I've had historically, but at maybe 15 times the effort, I kid you not. We're now going back to something similar to what I've done before, which is to evaluate the portfolio less frequently, but to then have a major makeover if necessary. We're going to start with every 6 months. Hopefully this should yield a similar performance, but also free up a lot of time, as well as being easier for anyone to keep track of.
All we have to decide is what to do with the time that is given to us.
We've also decided to reveal approximately half of the portfolio so you guys know what you can expect if you decide to sign up for the Patreon. Let's check out 6 of the companies that we own currently and that we expect to own for the next 6 months or so. There should be a disclaimer here somewhere. I've forgotten where I put it. Oh, yeah, there it is. First off is Careium, a Swedish provider of healthcare services for elderly people. They have hardware devices which elderly people carry with them or that is installed in their homes, which are connected to Careium's response centers in Sweden, Norway and the UK. When an alarm goes off, the staff of Careium decides what the appropriate course of action is. The business is non-cyclical with recurring revenues. Also, it has a wide customer base and is coattailing a megatrend. And they are the market leader in both Sweden and UK, which is like 60% of their sales. We've been shifting around a little bit, but we like to analyze a business based on 4 primary parameters: organic growth, return on invested capital or ROIC, business quality, and price. We expect that Careium will be able to continue growing in high single digits, with a fairly high ROIC of around 30%. And we think that the before-mentioned variables awards Careium with a 4 out of 5 in business quality. Now, what do we mean by that? Business quality? Essentially, you can view the profit or cash flows that a business is making as the total volume of water in a bucket. Growth and ROIC decides the rate at which new water pours into the bucket. And that's of course very important to understand if we want to estimate how much water there is in the bucket in, say, a couple of years. But equally important, or actually even more important, is if there's a hole in the bottom of that bucket or not. If the company is good at maintaining its customers and profits, then the hole is really small. We think for Careium, the hole is fairly small. But for something like a mobile gaming company, for instance, the hole is huge. The customers are very likely to switch to another product in, say, a year or 2. So that's what we mean by business quality. In Careium, we get all of this at a very reasonable price, in our opinion. Currently, the valuation is at EV/EBIT 13.37, That's a sign, by the way, if I ever saw one. And the PE is 16.8. However, baked into that number is also a non-cash flow item of amortization of intangible assets. If we add that item back in order to get closer to the real underlying cash flows of the business, we end up with an adjusted EV/EBIT of 10.9 and a PE of 12.5. That's too cheap for a quality business like this, in our opinion. Zumiez is an American retailer of skate fashion. They sell clothes primarily, but also hard goods like skateboards. They have some 597 stores in the US, 47 in Canada, 87 in Europe, and 25 in Australia. Most of them are located in larger malls. About 20% of the sales comes from private label. When it comes to growth, we think that Zumiez pretty much has expanded the store concept as far as is possible in the US. But in Europe and Australia, there should be some more room for expansion. The number of stores grew by about 2% per year during 2018 to 2023, and we expect that something like that, plus inflation, should be able to bring the organic growth to mid-single digits. The ROIC is at perhaps 20%, well, during a normal year. We'll get to that. For business quality, we would have had a higher number for Zumiez just a year ago or so. But the company has been taking quite a hit lately due to weak customer demand, and that has caused us to become a bit more defensive. Actually, the case here is now that of a turnaround, because Zumiez numbers are in the red. It's clear that Zumiez mid-priced fashion products are nowhere near a must-have, and because of that, and competition, the company becomes quite cyclical.
And, retailing is a good case of a business where you have to stay smart. You are under attack all of the time. People are in your store. If you're doing something successful, they're in your store the next day trying to figure out what it is about your success that they can transplant and maybe add a little something on in their own situation. So you cannot coast in retailing.
However, Zumiez is not alone in taking a hit right now. The same goes for competitors like Foot Locker and Tilly's. So it's probably a matter of time before the tide turns again and the whole group can be profitable. Meanwhile, Zumiez has no debt and even quite the war chest of cash, which is preferable in such a turnaround case. Look at this historical graph. It sure looks like, at least to me, that the company should be able to return to some $900 million in sales and an operating profit margin of, say, 7%. If that happens, the current valuation is EV/EBIT 6.6. During normal circumstances, the company has been valued around EV/EBIT 10, and if that happens again, there should be a substantial upside. There are no guarantees of this, of course, but the company has been around for a long time, and we don't really see why the ecosystem in which it operates should have changed permanently. The current problems that the company faces has brought down future expectations so much that we've become interested.
The closer we are to danger, the further we are from harm.
Next up is Wittchen. And no, Wittchen does not have anything to do with the Netflix series The Witcher, although that too is supposed to be great. Wittchen is a Polish company that manufactures, markets and sells suitcases, bags, clothing and accessories under the brand name Wittchen. It is an impressive growth story orchestrated by Jedrzej Wittchen, who runs the company together with his wife Monika Wittchen. They are owner-operators, which we love, and they own 60% of the company. A vast majority of sales are from Poland, and they are evenly split between their 115 stores and online channels. Now, can this growth story continue? Well, we think so. In the short term, we don't really expect any growth, as the comparables from 2023 are quite tough, with tourism and shopping having rebounded strongly after COVID, benefiting companies like Wittchen with half of their sales coming from suitcases. But in the long term, we expect them to continue gaining market share, using history as our best proxy for the future, and estimate a low double-digit growth rate from 2024 and onwards. We also expect them to keep their handsome ROIC of around 30%. So, we expect a good amount of water being added to the bucket of Wittchen. As for business quality, or the size of the hole in the bucket, we have given them a 3.5 out of 5. Wittchen is its own brand, which in itself provides them with a certain moat. At top of that, they have just shy of a 10% market share in their main categories, which makes them sturdier in the face of competition. On the negative side, any retail markets such as suitcases and handbags are very competitive, and Samsonite and Gucci and the likes are not to be taken lightly. Lastly, they are running a cyclical business, and we expect them to take a hit in a recession. So, there are definitely holes in the bucket. What do we have to pay for this? On a last 12 months basis, Wittchen trades at PE 10 and EV/EBIT 8.5. What would a company like this cost in the US? Double? Well, this is why Poland provides good hunting grounds. And even without a sudden increase in valuation, the earnings yield here is handsome and could single-handedly provide market-beating returns for the next few years. What's that? Oh yes, it's time for Kamux, our next holding. Kamux is a Finnish retail company that sells used cars. The business model is simple enough. Kamux acquires cars from various sources, including car auctions, private individuals, and leasing companies. It then performs some minor maintenance and brushes them up a bit before reselling them to private individuals through its network of showrooms in Finland, Sweden, and Germany. Kamux origin is Finland, and here they are the number one player, with a market share of 10%. In recent years, they have also expanded their operation to Sweden and Germany, which together account for roughly 1/3 of sales. So far, these two geographies run at a loss though. Regarding business quality, we have given Kamux a 2.5 out of 5. In other words, there are plenty of holes in their bucket. The main reason for our skepticism here is that there are some competitors who have taken a fair bit of market share in both Sweden and Finland in recent years, which makes us question how deep Kamux moat really is, even though they are still the number one player in their home market. In addition, as illustrated by Kamux performance in Sweden and Germany, it's clearly not very easy to turn a profit, which probably stems from the inability to differentiate from the competition, as all of them sell the same goods. Also, there's a fair bit of cyclicality in the industry, as upgrading one's car oftentimes can be postponed, although the level of cyclicality is nowhere near as high as for a business selling new cars. Okay, there's quite a lot of water pouring out from the bucket, but how much is being added? Historically, there's been plenty of growth, perhaps even too much given recent years' profitability issues. The founder and previous CEO had a sole focus on growth and maintained a goal of 20% CAGR for a long time. We expect them to slow down their growth rate considerably to a mid-single-digit level while maintaining a 20% ROIC. The new CEO has adjusted Kamux's course to less growth and increased profitability. And this is very much the case for us. A return to profitability and a reversion to the mean. On our long-term estimates, which include a 3.5% operating margin, Kamux is trading at EV/EBIT 8 and PE 8.5. That is just way too cheap. One has to remember that Kamux is currently doing everything it can to increase profitability. Honestly, to reach a 3.5% operating margin would only require them to maintain current profitability in Finland and stop losing money in Sweden and Germany, which seems very doable to us. As a reference, their goal is a 4% operating margin, which gives us a bit extra confidence in our estimated 3.5%. Olvi owns some of the top beer brands in Finland, the Baltics, and Belarus.
What?
Yes, I said Belarus, but hold your horses. Olvi is the market leader in a bunch of countries in a business that is non-cyclical and characterized by very slow rate of change. Competition-wise, this is one of the more well-positioned companies that we can think of, as brand is very localized in the beer industry, for some reason. 4.5 out of 5 in business quality. Growth-wise, the company isn't as impressive, but it's definitely not bad either. Olvi, like many other breweries, reports how many liters of beverage they sell per year, and that increased by 4.5% per year during 2018 to 2023. Organically, that is. They've also bought some businesses which made that growth look even better. Add some inflation to that and we're at maybe 6% per year if Olvi can continue in the future like it's done historically. And yes, we like to take that bet that a company that has done well in the past can keep doing well in the future too.
Just keep swimming, just keep swimming, just keep swimming, swimming, swimming.
Okay, so given what we've said so far, this certainly doesn't look like a business that should be trading at EV/EBIT 8.9 or PE 11.5, right? The issue with Olvi is that some of its profits comes from Belarus. The portion of total profits coming from there has increased during the last few years too. The problem here is of course that we do not know if something catastrophic might happen to that part of the business, like a confiscation or, something. But here's the good thing. If the rest of Olvi can return to its historical profit margins, that would be about 12%, then the valuation of just Finland and the Baltics is EV/EBIT 9.6. They are at an 8% margin right now, so this would require some reversion to the mean. But still, the valuation of the profits coming from just Finland and the Baltics even today is 15.3. That's lower than the valuation of the whole company, including Belarusian profits and all, before the Ukraine-Russian conflict in 2022. All in all, it seems that we have an asymmetric bet here, something that the famous value investor Munish Pabrai would describe as heads, I win. Tails, I don't lose much. Next up, we have one which, admittedly, might cater more towards people with a little higher risk appetite. On the Beach Group is an online retailer of beach holidays, primarily in the UK. Think of it as a local competitor of Booking.com. They sell vacation bundles, so the flight, the hotel stay, etc. all in one place. This is a company with basically no capital requirements, so the ROIC is more or less infinite. That's a very good thing, because almost all of the money that they earn can go right into investors' pockets, instead of having to be reinvested in improved production facilities, a larger inventory or what have you. 5 analysts expect that fiscal year 2024 sales will come in at about £200 million, which would mean a 10% CAGR since 2019, the last normal year for this business due to plenty of comparability issues stemming from COVID. 10% CAGR is a good job, and we do not expect them to be able to continue in that high of a pace, but maybe more like 6%? 6% is nonetheless a very nice growth if it can be achieved with near infinite ROIC. So, growth-wise, we think that there will be a lot of water coming into On the Beach's bucket. But business quality-wise, we think that there could be a leak in the bottom of that bucket. Issues include that there might be a winner-takes-all effect due to network effects, and that it will be difficult to compete with someone like Booking.com in the long run. So far, On the Beach has held on to its position quite well though, and reviews from customers seem to be pretty good, with 4.2 in average rating on nearly 60,000 reviews. Another thing affecting business quality is that this business must certainly be cyclical. Beach holidays is nowhere near a necessity, and that poses a problem too. If we must quantify the size of the hole in On the Beach's bucket, we'd say that their business quality is something like 2 out of 5. Still, on a next 12 months basis, this is valued at EV/EBIT 9.7 or PE 9.1. And we think that's a bit too cheap, given the very nice growth numbers that this company has put up historically. Finally, On the Beach gets bonus points for being an unusually cheerful company to analyze. Just look at this inflatable flamingo and these palm trees that they always have in their investor presentations. Beautiful! Alright, so that's the 6 companies. These 6 are some of the smaller positions that we have in the portfolio. If you want to see the most important ones, together with position sizes and longer write-ups on our portfolio companies, head over to the Patreon page. This is also where we'll update you ASAP if there's any portfolio changes. I don't know if this is the strongest pitch I've ever made, but you know what they say.
Unfortunately, no one can be told what the Matrix is. You have to see it for yourself.
Okay, that was a joke. But seriously, you can find the full portfolio at the Patreon. And the price is now $10 per month instead of $33. So check it out. Cheers!